Guys, 3 stocks at 52-week lows. A great place to look for value is 52-week lows. Mo and I own one of these stocks. The first one is NIO. Let's check it out. NIO is an electric car business that dominates somewhere. Let's see here. All-time high, $67 a share. It's currently at $6 per share. It hit the hype peak back in early 2021 when Nikola, NIO, Workhorse, electric was the go-to, and now it's AI. So market cap of $10 billion, $10.5 billion. Mo, enterprise value of $16.5. This difference is the debt on hand, and look at this cash flow and net income. Negative $1.5 billion last year. The average of last 5 years is negative $920 million. When's the profit coming? Guys, price to sales ratio, 1.4. The reason I bring this up is car companies tend to be in the 0.3 to 1 ratio of sales to market cap. So this is selling for over that by at least 40%. Now, is NIO growing? Sure. So it can justify a higher premium. And look at this revenue growth, Mo. Huge revenue growth, right? 210 million, 1.2, 1.7, 4.5, 6, 7.6. Big growth, but also big losses.
Now, you know what the funny thing is? You think back to when it was $66 a share, you would think, seeing that price fall, oh, they're probably a dying company, et cetera. Nope.
But that's the thing, guys. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. I get apprehensive when I look at companies that have a lot of losses and no real path to profitability. They're going to grow like crazy. For me personally, it doesn't work for me. If the price to sales ratio was absurdly low, if the price to sales ratio was like, I don't know, 0.25 and it was a growing company, I might make some sort of bet on it. But remember also, they're issuing a lot of shares. You have to cover these losses one of two ways, issuing debt or issuing shares. And guess what? They have a reasonable amount of debt. That's why I brought up the market cap to enterprise value. The difference here is essentially their debt. That's a lot of debt for a company with $7.5 billion in sales.
And so they have a lot of debt and they're issuing shares.
Guys, for me,
it's double whammy.
For me, it's a pass on that one. Again, there are people out there who are going to understand the car industry better than I'm going to. It's a highly competitive, high capital intensive business with low margins. Guess how much I like that?
Not very much.
Company number 2, Humana, healthcare insurance company, was at $4.55 last week. It's currently at $4.03 per share. Price to sales ratio 0.5. Isn't that funny, Mo? A lower price to sales ratio than NIO. With about the profit margin of a car company, 3%. Exactly. But the price to free cash flow here of 10. Look at these free cash flow numbers versus net income. Now, I will say this. Insurance business, health insurance business. Obviously, the premiums are year to year, but I look at this thinking to myself, insurance companies do things a little bit differently. So I don't know if this free cash flow is really something to write home about. I have no idea. I'm not an expert in the world of insurance. Me, unlike other people out there, if I don't understand it, I tend to avoid it. But Humana fell a lot last week, and it garnered a lot of attention from our users and from our community members here in the community, okay? So I wanted to take a look at it. Small dividend, $400 million. If you look right here, $400 million in this dividend, 0.9%. Not a ton. Not great, not small. Small PE. Man, I wish I understood insurance a little better. Let's look at the 8 pillars here. Now remember, guys, you can customize your 8 pillars, but look at this. We don't have the data for ROIC because insurance companies, their financials are different, right?
Right. I'm looking at the cash flow statement. The cash flow statement is just kind of all over the place. I mean, even if you start in 2019, loss of almost $1 billion.
Wow.
Next year, it's kind of erratic.
Quite erratic. Look at this, Mo. 900 million, 173, 4.5 billion, 3.7 billion, loss of $1 billion, 3.7, 5, 1.4, 8.4, and 5. This is all over the board. Yes. So Mo, even if you're going to look at this, if you understand insurance and you're going to look at this, you're going to want to take a longer term average. You can't go just based off 1 year. You have to look at the long-term average of the cash flow. Let's look at the income statement and see if that's a little more consistent. Net income here. Okay, a lot more consistent. 970, 1.3, 1.1, 1.9, 1.5, 2.6, 4.1, 2.7, 2.8, and 3. More consistent.
They've been buying back shares every year for the past decade.
Look at that. 155 million shares outstanding, down to 123 shares. Guys, I love that. And the reason being, if the stock is cheap and that price of free cash flow is good, which it is here, it's single digits, if that's reasonable for an insurance company, buying back shares gives investors more and more of the company as time goes on. That's a great thing if the shares are cheap. Right, Mo? Mm-hmm. So we like seeing that. Okay, so let's see. What do analysts say about the earnings per share? Oh, wow. $32 a share this year, going to $52 in the next 4 years. That's incredible. Yeah, big growth. What about revenue?
Big growth there too.
Except for the last year. I wonder why that is.
For the last year, I don't understand that one, but it's down to 2 analysts.
And remember, guys, analysts have their biases, probably even more so than you do. So just take that with take their input, not with a grain of salt, but remember where they're coming from. They want to get business from these companies, et cetera. So my guess is they'll either be more optimistic or more cynical, depending on where the stock goes, right?
Absolutely.
So for this company, my suggestion is engage. I'm sure you guys are going to talk below about when you're going to learn insurance companies. Comment below if you understand how insurance companies make money. Help the other people on YouTube, because insurance companies and banks are a different breed in how their cash flow is handled. So it's not just like buying a widget company or buying Microsoft or Google that has money in very direct. Because remember, when insurance companies take premium in, that's premium they're going to owe out in the future. And their goal is to make money on that premium while it sits in their account until they pay it out. That's their goal. Right. So they're making a spread. It's an arbitrage play. It's called float. That's what Warren Buffett has made. About probably some people estimate 25 or 30% of his returns are because he used float to go invest long term. Why'd you chuckle about that, Mo?
Because, I mean, that's crazy.
Yeah, but it's a great business model. But they got to be. Fantastic. It's a free loan. It's a 0% interest loan. And in fact, if they can invest at a profitable rate, it's a negative interest rate loan. They're being paid to basically invest the money, which is incredible.
That's wild. You just have to make sure you understand it.
Correct. Now, guys, some people in the insurance world say that return on equity is an important metric to look at. 18.4% here for Humana. That's a pretty high return on equity. Go do your research on other insurance companies, compare them, make sure this is consistently growing, because that could be a good metric. If that's true, and that's what matters in insurance companies, this sounds pretty good. All right. So stock number 3, the stock that Mo and I both own, Alibaba. China is so negative right now. Money managers hate China. Alibaba is currently selling for $67, an all-time high of $320. I've been dollar cost averaging on the way down sub. Well, the thing is, my basis is so much lower because of my dollar cost averaging and my tax loss harvest I did that worked out so I'm looking at going either way. I'm in a loss, obviously, on Baba. Let's go look at the income statement to start, and we're going to go annual here. They had a $20 billion for 2 years in a row, fell to 9, went back up to 10, but there was some loss along the way. Let's go look at their cash flow statement, Mo. That's going to be the biggest one to take a look at. Look at this cash flow.
Whoa.
14, 18.8, 26, 12.5, 23. $23 billion in cash flow last year on a market cap of $175 billion. That's like 7 or 8 times free cash flow. That's a ton of cash flow. Now, my thesis behind Baba. Everybody's negative on China. China is the world's largest, although they had the second year in a row of declining population, but a fastest growing middle class. And a lot of companies, like we use Alibaba. We've been using Alibaba for 10 years importing things. It's a very useful business, and it's stuck in a country that has a lot of negativity around it right now. That could very well be validated. This is a long-term play. It hit a low of $58 just a little over a year ago. It's a long-term play. If you can't stomach the idea of China going to war or something like that, you've got to figure this out. Now, people who say it's communist, I get it. They are run by the Communist Party. The number 1 country in the world with billionaires is the US. The number 2 country is China at 450 billionaires, and it's growing all the time. I think it's the fastest growing group of millionaires in the world. Guys, communists love money too. They just lie to you and say they don't. They want everybody equal. No, they just want them to be rich and everybody else to be poor. So
something I find very interesting is that we did a video on it earlier. Barron's actually put this as one of their top performing stocks for 2024.
That worries me.
Very strange.
That worries me. If Barron's is saying that you should buy, that's going to be top performing. Guys, first off, nobody has a clue what's going to happen over the next year. But let's go use Stock Analyzer tool and see. Let's look at the analyst estimates first.
Okay.
943 in profit for the year ended March 24th, 1237 for 2028. Revenue growth, not super fast, but there. Let's pull up the last Stock Analyzer tool. And this is important. And guys, if you've watched our videos, you're seeing us in this video. There's so many tools here. All these tools right here. Check it out. We have a free 7-day full access free trial. I'm not asking you to make a financial decision today. I want you to get into the software, use it from the inside so you can make an educated decision, an informed decision. Go to everythingmoney.com, check it out. 7 days, full access free trial. You get the community, you get all the tools. It's a game changer for you. So this is the Alibaba I did, but I did 9% returns just to see what I thought it was worth. But I think, so I did 3, 6, and 9% revenue growth. Mo, what'd you do?
I have 5, 8, and 11.
Okay, so a little bit higher than mine. Profit margin, I did 15, 19, and 23.
I did the same.
Okay. Free cash flow, considerably higher. I did 17, 22, and 27.
I have the same for that.
Okay. PE, I did 16, 18, and 20. And same with price to free cash flow.
So I did 18, 20, and 22 there.
Now remember, this PE is for the future, for 10 years out, right? And I feel like in the next 10 years, the story on China will probably shift here and there. And then for my desired return, I'm going to put here 12, 14, and 16% because of the margin of safety I want, the fear around China. I want to get paid for that fear. What'd you put, Mo?
I did 10, 12, and 14%.
Okay. Hit the analyze button. I got a low price of 95 to 110, high price of 200 to 230, a middle price of 140 to 160. What'd you get, Mo?
I have 138 to 155 on the low, 282 to 331 on the high, middle ground 200 to 230.
Great. Thank you very much, guys. Everythingmoney.com, free 7-day full access trial.